Buying stocks just because they have a high dividend yield is one surefire way to have terrible investment results.
That's a terrible idea.
Look at this one ratio instead to determine whether or not a company is a dividend yield trap or ultimately a legitimate long-term dividend payer. In this video, we'll talk about shareholder yield and why it's a superior metric to dividend yield. I'll explain to you why stock dilution is so bad for you as a shareholder, and then finally we'll look at two companies, Apple and Realty Income, to see dividend yield versus shareholder yield in action. The only difference between shareholder yield and dividend yield is that shareholder yield includes both dividends and what the company is doing with its own stock. So if a company is issuing equity or diluting existing shareholders, it gets subtracted from dividend yield. If the company is buying back its own stock, that gets added to dividend yield. So why is issuing equity so bad for you as a shareholder? Well, a company has basically three ways it can generate cash for its operations. One, it can make a profit. Two, it can borrow money from the bank or issue bonds. And third, it can sell its own stock to outside investors to raise money. Everyone seems to understand that raising debt eventually must be paid, and having too much debt is ultimately a bad thing.
It can't get any worse, can it? Obviously it can.
Issuing equity is something that I haven't seen too many investors talk about as being a problem, and the reality is it's actually worse, far worse than issuing debt. Let's look at an example of a bakery and I'll show you why that's the case. Let's say you have your own bakery. This bakery has 10 shares and you own 100% of those shares. This bakery is quite profitable and generates $100,000 in profits per year. Now you have $100,000 sitting in the checking account of the bakery that you can do a couple of things with. You could pay a dividend with that money, you could pay back debt if you had any, or you could use it to reinvest in your business. So let's say you have an opportunity to double the profits of your bakery by opening a second location across town. The problem is that you also want to receive a dividend of $100,000, and the business does not have enough money to do both things. You can either do one or the other. So you have a couple of different options. One, you could go to the bank and borrow money or issue a bond. Number two, you could decide to forego the $100,000 dividend and choose to reinvest the money instead. Or three, you can sell stock. So here's how this would work. You're going to basically create a share out of thin air. So before, you had 10 shares of the business worth, let's say, $100,000 each for a total value of $1 million. Afterwards, you're going to add one share and sell that to an outside party. So you're going to have 11 shares. The problem is that the business is not going to be worth any more. What you're doing is just simply changing the denominator. So you're going to take $1 million divided by 11 now instead of 10, which comes to a per share value of $90,909. So when you take 11 shares and multiply them by this lower per share number, you still arrive at the same $1 million. So now the ownership of the business looks something like this. You still own the same 10 shares, but instead of being worth $100,000 each, they're only worth $90,000 each, roughly, which means your total ownership of the business is $909,000 instead of $1 million. The outside investor that you've sold the share to, they also have one share, and that share is worth $90,909. So before, your ownership interest in the business was worth $1 million, and afterwards, your ownership interest was worth $909,000. The equity issuance gets more expensive the more successful the business becomes. So let's illustrate this. Let's say 5 years later, the bakery has been wildly successful. Let's say the total value of the bakery is now $5 million instead of $1 million. So if you had gone to the bank initially and borrowed the $100,000 instead of issuing equity, you would owe $100,000 and you would have paid some amount of interest over that 5-year period. So let's say the interest rate was roughly 10%. So you would have to pay back your $100,000 principal that you borrowed, and you would have to pay an additional $50,000 in interest. So at the end of the 5 years, you would own 100% of the business worth $5 million, and you would have paid out of that $150,000 to pay back the debt and the interest that you owed. So your net worth at the end would be $4.85 million in that business. The situation with the equity issuance is a little bit different than that. The $5 million business, you don't actually pay anything back. You don't have to pay that shareholder that gave you money, that gave money to the business. You don't pay them anything. You don't pay them interest. You don't pay them principal back. But they are the ones that own roughly 10% of your business. So instead of owning 100% of $5 million, now you only own 91% of that $5 million, which means your net worth in the business is now $4.55 million. So if we calculate the different options here, we can see that the most expensive option in this particular case of getting that original $100,000 was actually the equity issuance. That cost you $300,000 over the course of those 5 years in terms of the opportunity cost of you not owning the entire business. Borrowing money from the bank would have cost you roughly $150,000, even at a very high interest rate at 10%. The cheapest option by far would have been to use the profits from your business to generate the new opportunity. That would have cost you $0 to reinvest those profits. So the clear point I'm trying to make here is that equity is the most expensive way to fund a business. The cheapest is to use profits that the company generates to reinvest in the business. The second cheapest is generally to issue debt. And the third and worst option is to issue equity. So why would any company issue equity? There's 3 reasons why this might happen. One, and most commonly, the business has already borrowed so much money that either other lenders will not lend them any more money, or other lenders will only lend them more money if the interest rate goes up. So the debt is becoming more and more expensive as the company has more of it. So outside investors are less interested in taking that on unless the company pays a really high interest rate. Number 2, the investors, your investors, like and expect receiving dividend payments, but you don't have the money to pay them both the dividend and reinvest the business. This is the same thing that happened with the bakery example. You had $100,000, but you wanted to do 2 things with that instead of just one. So a lot of companies will issue equity in order to basically cover the dividend, which happens quite a lot. And a lot of the stocks that I see people buying are doing this very thing. And this is exactly what shareholder yield is intended to identify. And number 3, a company might issue equity because they believe their stock price is too high. Now obviously, every single one of these reasons are bad for you as an existing investor. So what should you do? Using shareholder yield instead of dividend yield solves a lot of these problems. You still incorporate dividend yield into the equation, but you're also combining that with the equity issuance, or in some cases, stock buybacks. So stock buybacks are the opposite of share dilution. The company is repurchasing shares, which means you as an investor, as an existing investor, are benefiting by owning a larger and larger piece of that company. So stock buybacks and shareholder yield are positive, and equity issuance are rightly penalized. So let's look at a real-life example. We have on the left, we have Apple, and on the right, we have Realty Income. Now, Realty Income, I've seen this stock everywhere in YouTube comments, people touting this as a great dividend stock. And of course, Apple, everyone knows that this has been a tremendous success growth story, but it's often viewed by dividend investors as having, too low of a dividend yield to invest in. But when we investigate this a little further, we see that yes, the dividend yield for Apple is 1.1%. Realty Income has a much higher dividend yield at 5.3%. However, what we see when we look at shareholder yield is that Apple is buying back 4.4% of their own stock each year, or over the last 12 months. And Realty is issuing 8.3% in equity, which means if you add these two numbers together for Apple, 1.1% dividend plus buying back 4.4% of the company, the shareholder yield for Apple is 5.5%. When we net the right side for Realty Income, we see that the large dividend yield is overtaken completely by the amount of money that they're diluting shareholders with. So the net yield is actually 3% negative 3%. So when you're looking at this from a shareholder yield perspective, you would have to conclude that Apple is actually the far better investment than Realty Income. Realty Income is actually reducing shareholder value by diluting shareholders more than they're paying them in dividends. Shareholder yield, in my opinion, is vastly superior to dividend yield. I've opened 2 portfolios at M1 Finance. I put $1,000 in each portfolio. One of those is the highest dividend yielding stocks in each of the 11 S&P 500 sectors. The other is the same 11 sectors, the same exact number of stocks, but rather than using dividend yield, it uses shareholder yield. So what I'm going to do is I'm going to just track how these 2 portfolios have performed over time. So I bought them on May 4th, 2020, and each month I'm going to update you guys on how those portfolios have been doing. So if you want to get notifications when those updates come out, you can hit the subscribe button and hit the little bell icon, and it will notify you whenever that video comes out. And we'll just see which one of these single ratios is superior. If you guys have thoughts on this, leave a comment in the comment section with which of the 2 ratios you think is going to be superior.